Thank you for joining us, everybody. My name is Conrad Mazeika, and I am selling Orange County. And I have a couple of guests today. They're backstage and getting ready for a great informational session. And if you're rewatching this, thank you for watching. So I have my co-host, Krystle Rains,
What's up, guys?
and we're both real estate agents here in Southern California. As you see, Crystle's in San Diego, and I'm in Orange County. And we have a special guest coming on up who is a loan officer who's going to actually go through the process and give you loan 101. So, who is this live stream for? This is for anybody that is considering buying or selling a home. And to know what to kind of start with the process in buying a home with a mortgage and see what's the best fit for you. But also on the flip side, when you're a home seller, you need to understand what loans are being offered to you. When will they close? How soon can they be? What are all the loopholes and everything else and potential hazards on there? And so at the end of this video, you have a really good understanding of what a mortgage is. So bringing on stage is Sabina Adamski, who's a loan officer. And we're pretty much here to kind of discuss with Sabina Loan 101. So, Sabina, if you could just tell us a little bit about yourself.
Hey, Conrad. Well, thank you. My name is Sabina Adamski. You pronounced it correctly. My parents would be very proud. I've been in the loan business since 2015, so I think this is my 11th year now. And the loan business is ever changing. What I love is that you mentioned that this is the starting point, right? Talking to a lender. And too many times, I think people end up talking and getting in way over their heads and looking at real estate before actually getting pre-approved and talking to a lender and understanding what the numbers look like for them. And so I meet too many people where they're just like, I found a house, I want to write an offer on it. And then they're just like so shocked about the money parts or how they did not plan accordingly or any of that. So I love that you mentioned that really, talking about finances and loans is the beginning part.
Absolutely. It's the best starting point. I mean, Krystle, you as an agent, have you ever been in a case where you had a buyer that said, hey, Krystle, I found the perfect home. What do I do?
2000%. Putting the cart before the horse is never the right idea. I think that people fall in love with properties all the time, and it's devastating to have to work backwards. I think that starting with loans is the absolute best starting point that you could have.
And I get it. I 100% get it. Like, it is the fun part looking at homes. It is the fun part thinking about, picturing your family and the holidays and everything. That's the fun part. And the lending part, I wouldn't describe it as fun. I think it's fun mainly because I'm a nerd and it's what I do for work and it's what I do all day. But I do tell people, I'm like, I understand it's not the fun part, but it is an important part, probably one of the most important aspects. And I tell people, I'm like, I'll make it as painless as possible for you and I'll walk you through it. You don't have to know everything. It's just, knowing what to expect in the big picture aspect, but then also knowing that you're going to have a great team behind you holding your hand throughout the process.
And I think a lot of people, and you can kind of share a little bit, while we go through this video, is like the fears I think that people have. So if you can find a way to kind of address that, as we're going through today, I think that would be wonderful to, have that discussion, because I think people have anxiety about giving your personal information to somebody else.
Oh yeah.
And I think it's really, really important on there. So let's kind of get into some of the questions.
All
so
right.
First question that I have is, what are the main loan types for somebody that's looking for their home to live in?
There are tons of different loans, and I'll kind of simplify it because Some of the loan types, I'm like, let's just call them portfolio. Now, those are probably what is going to consist of jumbo loans and non-QM loans. Non-QM loans are relatively newer to the market, where we have so many investors and so many options, and it's not just for non-grade A people anymore. Everybody's doing non-QM loans, especially in, the Southern California market, where people have complicated income. It's a high income area. And so that does not necessarily mean it's easy income. It's usually complicated. We've got a lot of business owners, we've got doctors, we've got everybody who's got all sorts of different income sources. So non-QM loans can really encompass some of the more creative financing options. So I lump jumbo and non-QM together into portfolio. So we'll call that portfolio loans, mainly because it means that it does not follow the standard conventional loan guidelines. And so it's not just Fannie Mae or Freddie Mac. We're looking up specific investor guidelines. And so a conventional loan, that's the most common loan that we're going to see across the United States in general. A conventional loan is guided by Fannie Mae and Freddie Mac, and it's what sets the guidelines for most investors, even outside of Fannie Mae and Freddie Mac, is we usually divert to Fannie Mae or Freddie Mac when an investor is silent on a certain part of the guideline we're trying to make sense of. And then FHA loans. Those are also really great loans and used all across the country. Every county has a different loan limit for an FHA loan. So most of the country has a lower FHA loan limit. I think it's somewhere in the 600,000s now. But when you're dealing with a high cost area like Orange County, San Diego County, LA County, the FHA loan limit is going to be equivalent to the conventional loan limit for the county as well. So it gives everybody a little bit more flexibility in having a lower down payment. Even if you're buying $1 million home, you can still buy it with as little as 3.5% down. And then FHA actually gives us a lot of flexibility when it comes to, maybe some blemishes on credit, and then also the debt to income ratio, which is one of the important ratios that we follow in the loan world.
Very cool. Super informative.
Okay.
I like that you explain the combination of the jumbo, like as a portfolio. It's really cool.
Absolutely. So, okay. I think you answered a bunch of those questions all in one that I have at the beginning. So what is the difference between pre-qualification, pre-approval, and fully underwritten pre-approval?
Okay. I'd like to think of it as green light, yellow light, red light. If you guys as a realtor see a pre-qualification letter from a buyer, I would say that's a red light. Like, you should stop and be like, hey, this is a pre-qualification letter. Did you actually talk to a lender and get pre-approved and submit documentation? Because you guys and I know it's 2026. Anybody can go online and get a pre-qualification letter at any time. You could just type it in online, submit your information, and you'll be getting hounded by some call centers and everything. But you'll have a pre-qualification letter based on what you input. And nobody verified the documentation. And so that, to me, that's a red light for you guys to just, whoa, hold on. How sure are we about this? Because you want the client to be sure about it too. It's not just you guys being out there and looking within the price range for what they were pre-qualified for, but it's also on them. If they get into escrow or under contract for a home and they put their earnest money deposit up, and that's now at risk if they don't end up, being able to perform. And so getting a pre-approval letter, that's, I think, what we call a yellow light. Unless it's from me, I would still call that a green light in terms of lending. But I'd say a yellow light is a pre-approval letter from a lender that you don't know, because it should have been vetted by the loan officer. The loan officer should have collected income documentation, should have reviewed the credit, should have reviewed the assets, and signed off on it and covered anything that can come up, and ran the automated underwriting findings, checked all the guidelines. And that should be what has happened when you have a pre-approval letter. Now it's lender specific. We know a lot of different lenders in our industry. Some are on it, some are not. Some will just issue anything. So that's why I say it's a yellow light, unless you know the lender and you know their work style. And then the green light pre-approval is what I would probably consider the underwritten pre-approval. That's where we do the full underwrite. We're going to request all of the documents that you need and submit it to underwriting. And this process takes a little bit longer, sometimes up to a week, just depending on how quick the buyer is with getting us everything we need, because we're going to need all the pages of the bank statements. We're going to need all the pages of whatever we need to verify your income. And so I like the underwritten pre-approval because it helps clients waive contingencies when writing an offer, makes it a little bit more competitive, but it also gives the seller the assurance that every seller wants, right? Every seller wants to know that the buyer is not going to cancel the transaction because they can't actually get a loan on the home. So I think an underwritten pre-approval letter helps you submit a more competitive offer, mainly because the seller is getting that assurance that they want. They want to know that it's not going to fall out of escrow.
And that is also a testament to how important it is to start with the lending process, right? Putting the cart before the horse and finding a property and falling in love with it before you know that you're capable of buying it. It's not just a waste of time, but it's a waste of emotion and a bunch of other things. So
exactly. Unless you're okay with heartbreak.
Right.
I don't think anybody is with their dream homes. So you don't want to do that. So we're trying to save buyers from losing their dream home.
For sure.
And then you start the whole process. Krystle and I work with buyers that you're in conversation with them for about a year or so, and then all of a sudden I missed out. I didn't follow the directions. Didn't get a pre-approval. I'm sorry.
Ouch.
Sorry. Ouch. Okay.
Quick shout out to Tiffany. We got one of our former clients here on this live, and I think that's really awesome that she joined and is not just supporting, but she's like, hey, this is cool information. Learning about the loan process is so important. Yeah. So shout out to you, Tiff. We love you. We miss you. She relocated to Oregon, so I miss my girl. But yeah, I appreciate your support and being here, girl.
Awesome. Okay, so lenders definitely care about some things more than others. How does credit score ranges unlock a better loan option?
Well, the better the credit, the better the rate. And at that point, you have a better loan option. So the loan level price adjustments, that's what the technical term is in boring mortgage jargon. But basically what we say, it's just like a hit to the rate. Usually, if your credit is under 780, you start getting hits to the rate or loan level price adjustments about every 20 points or so. So 760, you're still getting a really good interest rate with very little hit. But once you're under 760, you start noticing that the rates go up a little bit, and then even more so if you're under 700. Now, there are certain exceptions to these loan level price adjustments or pricing hits, and that's if somebody's income is under the area median income, they can get a loan with no pricing hits. If they're just getting a home ready or home possible loan, they can get away with not really having any pricing hits. So having better credit is better for you overall. Not to say it's not possible. That's where FHA can really come in into play, because they don't penalize you when it comes to the interest rate in having a worse rate. If you have worse credit, they don't really look at that at all unless you're under 620. That's where it gets a little bit more creative. But as long as you're over 620, you're likely to have a very similar interest rate to somebody in the 700s when using an FHA loan. So
we've got a question here about USDA loans. Can you touch on those maybe for a second?
Well, we'll jump to that at the end. At the end. So keep going, Sabina.
But yeah, so yeah, the better the credit in general is the better the interest rate. But that's not to say that's always the case. It really just depends on your specific loan scenario. But, you know, ideally, try to keep paying those on time, making those on time payments, having good credit. It's really important in this part of the process.
Mm-hmm. Okay. What I just have as far as a question. Oh, okay. What is debt to income ratio, and why is that part important?
It's probably one of the most important ones. Besides, I mean, I say that about everything, right? But for me, debt to income ratio, that's basically how we qualify you. I think it is probably more important than the credit, because credit can always be improved over time. Debt to income can also be improved over time by getting those debts down, but it is kind of more difficult to get that income up, especially if you're in a salaried position and you don't really have the flexibility to do so. So keeping the debt down is important, but debt to income ratio is exactly what it sounds like. Your debts divided by your income and monthly gross income. That's how we calculate it as lenders. So all of your debts, including the new housing payment and your car payment and your student loan payments and your credit card payments, divided by your monthly gross income. That's before taxes.
Before tax. Okay.
And it's the way a lender looks at income. So many people will be like, I make $80,000. And then I'll look at it and be like, oh, but you know, some of it is variable from overtime and some of it is this, and you just changed jobs recently. So it's whatever qualifying income we use to calculate the debt to income ratio. And so that's where it gets a little bit more complicated. But if it's an $80,000 salary, then yes, cut and dry, divide by 12, and that's your gross monthly income.
I mean, that's why, like, I don't even touch that. How much you make, the credit score, like,
yeah.
Nope. Just go to the lender.
A lot of people don't know.
Yeah. I don't want to get in trouble. So,
yeah.
You know, I know that there's assuming like the different rates that you can advertise and all that. And like, nope, I'm not touching that with a 10-foot pole. Okay. So I guess it's a question. How do student loans, car payments, and credit cards affect approval?
Great question. Greatly, right? It's a key piece of the debt to income ratio and the most important part of the qualifying process. So I will tell you that they are used against you. So I cannot tell you how many people have $1,000 car payment lately. That seems to be the new norm. Or close to it. I didn't realize it. I was like, why does everybody have such a high car payment until I needed a new car last year? Yeah. And I was like, oh, okay, that's how easy it is. Long gone are the $400 car payments. So we use that against the client. We count that in as part of their debt to income ratio, along with student loans. You know, even if they're in deferment and it's a zero payment and you're not making the payment, as lenders, we still need to use a payment. And typically, you know, we will either do 1% of the loan balance or 0.5% of the loan balance, depending on the loan program. FHA gives us a little bit more flexibility with the student loans as well. So that's another reason somebody might go with an FHA loan. So if it's a zero payment, we have to document something, and we're going to go ahead and put in that larger payment of either 0.5% or 1%. So if somebody's got $200,000 in student loans, I just actually was working on a pre-approval before this call where they had $200,000 in student loans. And so using Freddie Mac, we're able to just count $1,000 payment against him, but that's $1,000 payment still. You know, that lowers their ideal monthly payment for their home by $1,000. And so it's very important in the process. Your credit cards are super important. It's not unusual for someone to have to pay a credit card off at closing, or you know, pay their car off at closing. Actually, I think I have like 3 borrowers in process right now in escrow where they're paying off a car or a credit card. And I will tell people usually ahead of time during our loan consultation, I'll be like, don't pay anything off now unless you want to. Don't spend all your money on it. If that's not your goal, we'll do it at closing. You don't have to do it now. We could do it at closing. It makes it nice and easy. The escrow company just cuts a check directly to, Chase or whatever the credit card company is, or the auto loan. And it's super easy to just include it to be paid at closing.
Okay. So if a buyer is looking at, jumping into the home search 3 to 6 months from now, so not somebody who's just pops up online and sees it, for sale, 3 to 6 months from now, what will be the best case for a buyer to strengthen their overall credit profile and loan approval?
Well, it would be to have a loan consultation, right? So depending on what their scenario looks like, it'll be specific to them. For example, last night I was having a conversation with a young couple looking to purchase in Orange County, and they're about 1 to 2 years out, which to me, I always say, I'm like, I don't care if you're looking to buy tomorrow or 2 years from now, let's have a conversation so that you at least know how to prepare. And I'm so glad we had that conversation because one of them is self-employed. So we know that can be a whole mess where, you're bringing in this much revenue, but maybe you're too good at finding the tax write-offs. And so your actual on-paper income is lower than you think. And then the other partner was a nurse. And so her income is variable, which is very common among nurses. It's very unusual to find a nurse who doesn't have the shift differentials and the overtime and the double time and the weekend bonuses. So, it's variable. And typically with variable income, you want at least a 12-month history of receiving that income. And so I'm like, okay, you're a nurse. That's great. I gave her a tip. They weren't ready to, submit everything to me. But the main tips I gave them was, don't, change jobs right now. Let's review everything before you want to change jobs so that I can at least tell you how that's going to impact your qualifying 1 to 2 years from now, because what you do today will impact what you do 1 to 2 years from now or 3 to 6 months from now, like you said. So I'd say the general advice I gave them was pay your credit cards on time. Don't max anything out. I told them, don't buy a new car right now. I'm like, definitely check with me before then. Always prioritize your home purchase. Always, do the little things to save money. And I know everybody's a little bit facetious when they see something that says like, hey, well, don't get Starbucks every day. That's how you buy a house. And it's everybody's like, well, that's not possible. How would $5 a day get me a house in Southern California? And I always say, it's about the small habits. If you skip out on that coffee at home and not coffee at home, don't skip the coffee at home. Skip the coffee at the coffee shop, make your coffee at home. You're likely to make other little adjustments throughout your days and your weeks and your months. And those adjustments really add up and help you save.
Awesome.
I totally agree with that. I tell people all the time that their small purchases are actually the things that are holding them back and keeping them stagnant from, affording. They're like right on the brink, but they have like certain habits, and so if you can just minimize those by a little bit, just like you said, oh my gosh, such a game changer.
It's compounding habits, same with interest and money in your investment accounts.
Compound Effect, great book.
Exactly.
That's a great book for everybody. Anybody watching, and need something to read, Compound Effect, wonderful book. And I like to listen on audio, but
yeah, you can. It's on audio too. I'm an avid reader, and I love reading about real estate too, real estate scenarios, like all of it.
My current book right now that I'm listening to and sometimes reading, but I'm an audiobook person too, just because I'm driving and I'm all over the place. Atomic Habits.
Yes.
Oh, so
yes.
good.
Very good book. Very good book. And I listened to it on audio. Very good.
Yeah.
So
that's actually one of the few audibles that I went all the way through I'll never forget the first time that I read Atomic Habits. There had been like a storm at my mom's and I was doing a lot of landscape work, and it was so good. I could not put that thing down, and I got so much of the backyard done because of it. Like, it was amazing. Great book.
That's what's up.
Yeah. All right. So next question that I have is, what are minimum down payment options?
Depends on the loan program. So if you're a veteran or a veterinarian or another kind of physician, you can buy with as little as 0 down. So with a VA, the limits are going to be really just dependent on your purchase price point and your income. Although the VA is pretty generous in the debt to income ratio aspect of it. So you can purchase, let's say if you have the income for it, a $3 million house using a VA loan with 0 down. And then a physician, a doctor, veterinarians included, ophthalmologists, eye doctors, all included as doctors, they can purchase with as little as 0 down for up to $1.5 million. Anything over, they'll probably want to do at least 5% down, but it's called like a physician's loan program, and physicians love it, right? They might have some student loan debts after graduating. They probably want to focus on putting money towards that versus the down payment. And you're not penalized for putting less than 20% down. It's like the only profession that actually allows it, and you don't have to pay PMI or mortgage insurance for putting less than 20% down. So that's huge.
You learn something new every day. I didn't.
Yeah.
Now
I had a client that I had a client that was at 5% down. That was a physician. So I got some phone calls to make, Sabina. Thank you for
yeah, you bet. Up to 1.5 million.
Who knew? Like, this is amazing. Oh my gosh. I'm excited. Yeah, that just gave me a couple people that like popped in my mind to give a call to too, just because down payments are a significant part of the process for people. And I think that they can often put people off or be intimidating. So that's just a huge advantage that I didn't know about. Good on you, girlfriend.
Yeah. And I think the main thing is everybody's got this. I thought we're like way past it. I thought everybody knew already, but like you don't need 20% to purchase a home. But everybody still thinks that. And everybody's so afraid of PMI or mortgage insurance. And I'm like, if you have good credit, it's actually not that bad. And then sometimes I'll like show people putting 10% down. And I'm like, yeah, so you're actually going to be paying about $70 a month in mortgage insurance until, you reach 80% or 78% loan to value or refinance out of it. And they're like, wait, what? That's it? I've been saving all this money for all this time. And I don't even need to pay that much in PMI. I think people think it's like $400, $500. And it is in some cases, right? Mm-hmm. But now for everybody else besides veterans and physicians, you can purchase a home with as little as 3 to 3.5% down if it's within the conforming or high balance conforming loan limits. So, that you have some flexibilities there. Once you start entering the jumbo loan world, which in, let's say Orange County, it's loan amounts over like 1.248, you're probably going to need at least 10, 15, 20% down, really depending on the loan scenario and how strong of a loan you have. Those are the portfolio products that I was talking about. And so, so you can buy with as little as 3.5 or 3% down on the conventional and FHA side.
Great. That's good to know. I mean, as somebody who is a former financial planner, I get in discussions all the time about the 20% down. And I think, you're chasing the savings, and at the same time, you're chasing the, home price value. So, So if a home, which is, worth, let's just say $1 million, like here in Orange County, if the market goes up 5% a year from now, that's another $50,000 in equity. And you want to save an extra 10%. So, come in with another $150,000 by waiting a year.
And you're waiting a year, right? And really, how many people can save $150,000 in 1 year? It's hard. And I tell people all the time, Homes are going to continue to appreciate. That savings target is always going to get a little bit higher, and you can never outsave home appreciation.
Right.
Like, for sure. Like, you can't save that much money that quickly unless you're making, you know, $400,000, $300,000, $400,000, $500,000 a year, and you're really good about your spending habits.
Absolutely. And I mean, on the financial end of things, take that $150,000, put into, you know, bonds or stock dividends to pay for the PMI. Like, you know,
Right.
like there's lots of ways to kind of go about this financially, and that I think there's a lot of misinformation out there on the internet. You know, people want to sell books and attention and followers and all that other stuff, and run it with your financial planner, your financial advisor, and your loan officer. They can work together. Yeah. So that's I'll get off my soapbox right now. And,
you know, I've noticed it's actually, I feel like the you know, a lot of people want that lower payment. And so they're chasing and they're saving to get that lower payment because they're like, what if something happens? I'd rather my payment be lower. And I'm like, well, what if something happens? Wouldn't you want some money in the bank to like hold you over, or, you know, have investments that you can pull from? Because I think that's more conservative and, you know, the safer option. But I feel like some people think it's more conservative to try to have that lower payment and get that mortgage paid off as soon as possible. But you know, and it's not just because I'm a mortgage person, but maybe it's because I understand how mortgages are a tool towards financial success, that I am like, oh, it's much safer to just have money you can access at some point in case something does happen.
Yeah, if a heart attack happens, how long is it going to take for that loan to, you know, take that money to pay for the heart attack, or you have cash in the bank?
Right.
So that's that. Okay. So next question I have for you, Sabina. So what counts as acceptable funds?
Are we talking about crypto?
Oh, no. Well, I mean, okay. You threw it out there if you want to talk about it for a second because of all the people out there.
As long as cryptocurrency is sold and, you know, converted into USD in a normal bank account or a normal investment account, then we can use that as cash to close, down payment, reserves. Crypto accounts, it's gotten a little bit better over the years, but previously it used to be really hard to source the movement of it and provide statements. A lot of the exchanges didn't really have like a formal statement, and we're like, oh my gosh, it doesn't show all the stuff that we needed to show. But rest assured, they've gotten better. The exchange companies where you're holding your cryptocurrency, and investors are adapting too. So it's not to say that soon we might not have, you know, investors saying no to crypto altogether. I think that they're also adapting as, you know, time adapts and more people have money in cryptocurrency, and investors are becoming more creative. But as far as acceptable funds in, you know, most cases, most people have their money in their checking, in their savings, in their investment accounts, in their retirement accounts, and those are all acceptable sources. What's not acceptable is going to be money under your mattress, if people still do that. You'd be surprised. And then just cash. You know, large cash deposits are really difficult to verify in the sense that you most of the time cannot verify it. There are certain exceptions. For instance, if you're getting married and you have large cash deposit, we can make an exception for that, but we usually request document. You can't just say you're getting married. We would request documentation and proof that you were married on that day. And so, you know, that deposit that followed a few days or a couple weeks after can be sourced, and it's okay if it's cash in that one instance. Now, gift funds typically need to be given by a family member or a close friend. really cannot be given by like an interested party to the transaction, cannot be given by just a random person. And a lot of times, you know, it has to be close family. So like a second cousin might not count. And a close friend sometimes needs to be documented in the sense of like, well, let's see the proof of this relationship somehow. Not every time. That rarely happens. But, you know, if somebody has a hunch that they're trying to pull a fast one on the underwriter, that might be requested.
Yeah. How do you evaluate okay, so let's get away from the crypto question, but how do you evaluate like stocks and bonds on there? Is it like the day of the trade, they have to cash it out, or it's a valuation on a certain day? Like how's
so
that work out?
Basically, it's whatever it is. So the last statement that we have on file, that's going to be the balance. If you need to liquidate it for closing and the underwriter needs to see that, most investors don't need to see the liquidation of investment funds unless it's a very nuanced investor, right? So then you would transfer the money and then we would just show that money coming out of there and going into your new account. And so, yeah, it's just based on the last statement date or the day of the transaction and what happens there. If you're using it for reserves, some programs require reserves, and that's just cash left over in your accounts and investments and your retirement after closing. That's the money that you have left over after all the money you put towards the down payment and your closing costs. And so sometimes we calculate like 80% of your investment accounts as reserves, or maybe 70% of your retirement accounts as reserves, just because, you know, everybody understands that those sometimes fluctuate.
Okay. What money mistakes, Krystle, here's our favorite question as realtors in the middle of a transaction. What money mistakes can derail a loan before closing?
Well, don't you test me. I got all the answers. Yeah, I've experienced way too much.
For me, yeah. I've probably seen a lot of things that can derail. I'd say the number one thing is hiding or lying about something to your lender. The underwriting process is extremely intrusive. And, you know, with technology and AI and all the things that have gone through with just developments on the mortgage side, things will be caught. Like, even if you're trying to hide something, most of the time things get caught, and that ends up derailing the process. It doesn't always kill the deal, but it means we need to pivot. You know, if you were trying to get away with not filing your tax returns for a few years and the underwriter caught on to that, guess what you're going to have to be doing during the process is filing those tax returns. And guess who's going to have to show that they're able to pay those tax liens at closing or prior to closing? It's those kinds of things that don't necessarily, you know, kill a transaction. They could, but it would derail it in the sense where there's some problem solving to be done. So I'd say number one, lying or hiding things. Number two, quitting your job. That's one you can't really recover from unless you find a new job like right away. Number three, buying a car or a boat during the process, or even maxing out your credit cards. You know, I like to tell people, and I try to remind them, like, hey, don't buy your furniture before you close. I know it's tempting to open up a new credit card and just start buying all your new furniture so it could be delivered on your closing day, but like, let's just get there first. It's never that important to have all your furniture on your closing day.
You can't close, you can't get the keys to the house, so you might as well put the furniture on the lawn of the house that you were trying to buy.
What are you going to do?
Yeah. Those are some pretty doozy things.
You want to hear a story?
Go ahead. Story time.
Okay.
Story time.
So there was this one transaction, and I think every lender has certain transactions that like stick with them through the years. And this was when I was a loan officer's assistant. So fortunately I was not the loan officer on it, but she could not have prevented any of the things that have happened. And so I remember this was in Illinois. That's where I'm from. Sorry. And so we got an email from the appraisal company, because we have to order appraisals through a third-party company usually, so that it's a random assignment. So we got an email from the appraiser saying that they were at the property, and it was down to the studs. Only like the counters were intact, and there was like nothing going on. It was in the middle of a full remodel, and so the appraiser was like, do you guys still want me to appraise this? Like what's going on, you know? And so immediately we're like all on the phone. We're like, wait, what is going on? And it turns out that the buyer asked the seller's agent, and, you know, they had their agent ask if they can have her dad come in and just clean a few things up before the appraiser gets there and whatever. And so they agreed to it, which I feel like so many lawsuits could have happened, right? And so, somehow that happened. And so, you know, they're like, yeah, you can clean it up, do whatever, freshen up, whatever you want to do. But he didn't know that they were just going to like try remodeling the whole place. And so they had to get it into decent condition before we can order the appraisal again. And so that ended up derailing it probably for about 4 to 5 weeks. And then after that, the co-borrower quit her job.
Oh.
And she was a teacher. So we're like, wait, what? Like in the middle of the school year? And she just quit her job. And we were just like, oh my gosh, like everything that could go wrong on this loan is going wrong. So she ended up having to get a co-signer. They bought the house, but lots of problem solving.
How long was that escrow, if I may ask?
It was in Illinois, so it's an attorney state, and it's really not uncommon for them to go a little bit longer just because it's a little bit slower, and nothing's as fast-paced as California real estate. But I remember then, gosh, I was probably like 24 or 25, so it was early in my career, and it was probably at least 90 days. Which is impressive if you think about all the things that have happened.
Yeah.
Right,
Yeah.
for sure. Wild time.
Oh, yeah. Yeah, Krystle, you had a story, Krystle.
Oh gosh, I don't even remember which one it was. I've just been through so many different things. I've had buyers in the middle of escrow or like the week before we close make outrageous purchases. One of them purchased like an exotic animal, which I was kind of like, that's cool. You just set us off track completely. Like, what are we going to do? It's always, I don't know. I feel like it's more common than not. But again, it all depends on like your lender and how well educated you are and how well they educate you. Because some people just don't know and then they go and do it. And it's like, absolutely blindsiding, right? Obviously, as realtors, we advise them all the time. I think that sometimes people don't take our advice 100% of the time, so they still can get themselves into situations. So when the lender doubles up with us and kind of backs us and says, hey, just a reminder, this really can set you back or completely put a hole in the boat, that's really, really helpful. You know, that's why the importance of who you matter is key. Who you work with is absolutely critical. And like the team that you build, it's not just your realtor or just your lender or just an appraiser or just an inspector. It's genuinely the accumulation of all of us and how we work together.
Yeah.
Well, I think it sounds like exotic animals being purchased in San Diego is a very common thing.
You know, I wouldn't say that it's common. I had a very weird experience like many years ago where there was a wolf on a property, and that was like ended up being part of it. But yeah, people do interesting things here. They do interesting things in Orange County too, I've got to say.
I've yet to run into anything interesting other than finding out the marital status of my buyer a few days before closing. So
that can be a game changer for sure, because let's say, for example, they're married still legally And let's say, theoretically speaking, they're not getting along, and then you got to get that statement of information signed so that they can move forward with the purchase and close. What if somebody wants to be difficult? Boom. That's why you should always be honest with your realtor and with your lender. The more we know, the better. You know, it's just like your doctor. Like you said, Sabina, you know, people who lie and mislead and stuff, it's harder for us to help people if we don't have fully encompassed information. So the more we know, the better we can serve.
I'm with you.
Yeah. Maybe we should do a segment totally on escrows from hell.
We should. I don't know. We should. I've got stories for days.
Oh my gosh. I think I'll just listen in because mine are like traumatizing. I don't want to relive them.
Yeah, absolutely. So as Sabina and Krystle said, you better tell the truth. We're going to figure it out at some point. My father's been in the business since 1986, over, so 40 years now, and 800 homes sold. And he always said, you never know someone truly until you're in a real estate transaction with them. So
that's fair.
It's equivalent to living with someone for real.
Absolutely.
That's when you really get to know.
All right. Yes. Okay. So Sabina, let's talk about long-term and something that's not emotional, which, loans aren't really emotional except for when you find out the bad news and can't figure it out how to repair it. But how are interest rates determined for an individual buyer?
That's a great question. It is not always just the advertised rate. So usually when you see an advertised rate, that is usually assuming best case scenario, or even when you go to like mortgagenewsdaily.com, it's usually assuming perfect credit, usually assuming 25 to 40% down. It's usually assuming maybe even points are being paid, but it's the overall risk profile that comes into play. So what type of property is it? Condos typically have higher rates than single family homes, unless you're putting 40% down. It gets better when you do 25% down, but to completely eliminate the loan level price adjustments or pricing hits, you need to put 40% down. So the best rate is usually when you're doing 40% down. You get a really good rate when you're doing 25% down. It's usually better than 20% down, and usually better than the lower options. So usually, right? Every scenario is a little bit different, but definitely credit score, that's the biggest determinant. Then you've got the loan type, the down payment amount, and the property type. Those all come into play. And whether somebody plans on occupying the home or renting it out or just having it as a second home. So that comes into play too. Typically, investment properties have higher rates than primary residences. And that's why occupancy fraud is so big and prevalent. And that's something that the FBI definitely looks out for, is mortgage fraud relating to occupancy fraud. So that's the most common mortgage fraud out there. And so right now, our investment rates are really good. They're very, very close to the primary residence rates, but that's because investors typically put more down.
Yeah, don't lie. Once again, don't lie.
Not worth it.
Yeah, absolutely.
Underwriting does get invasive, like you said. Like, they really are very on top of it, and they do their homework. So I agree that that's like such an important detail to remind people of, is like, don't fluff, don't miss a beat, everything, every detail matters.
And even if you do pull a fast one on your loan officer and underwriter, the FBI is watching. Like, they're looking out for those kinds of things. So, even if you do pull a fast one on your lender, on your loan officer, on the underwriter, just know that things can come back and bite you.
For sure.
Or your realtor too. I don't know. No, nothing. Nope.
Right.
Don't lie. Yeah. So this is my video evidence and Krystle's video evidence. Do not lie to your lender ever.
Don't lie to either of us, but not the lender especially.
Yeah.
We're all going to catch you. It's just a matter of who catches you and how fast.
And the thing is this, it's a federally backed financial instrument. Federal backed.
Yeah.
The Fed's involved. Go ahead.
Even whether it's, I feel like even if it's a conventional loan, which is federally backed because it's Fannie Mae and Freddie Mac, or a government loan like VA or FHA, or even a portfolio loan, the back end investors on those are banks that are federally backed. Like when banks get into trouble, who gets in there to try to save them? So at the end of the day, it's like the feds are always involved.
Yeah.
So good point.
Yeah, no more. Yeah. And that crap.
Yeah.
Okay, so Sabina, what is a rate lock and when should buyers consider using a rate lock?
Great question. So it is exactly what it sounds like, but most people still don't understand it because a lot of people don't understand that the rates fluctuate daily, sometimes multiple times a day. We actually had a reprice for the better today. Sometimes we get a reprice for the worse. It's really just dependent on what's going on in the market. And so it changes every day. So until you're actually in escrow under contract to purchase a home, most of the time you cannot lock in your rate. Now there are some like lock and shop programs that people have used in the past, but in a mortgage rate environment like this, where rates are expected to drop at some point, probably not soon, right? But at some point, you're probably not going to be wanting to do a lock and shop kind of agreement where your rate is locked before you find a property for like 6 months, just because it's going to be expensive. Locks are usually by time, usually, 15 days, 30 days, 45 days, 60 days. The longer the lock period, the more expensive it is or the higher your rate is. So either you'll be paying points for a longer lock period or you'll have a higher rate to compensate for that lock. But once your rate is locked, it's no longer subject to market fluctuations. So typically, when somebody opens escrow and we're already looking at their rate options, they can either lock in the loan or float it. And if they float it, it's still subject to market fluctuations. If it's locked, it's locked. You know what your payment is going to be. You don't have to stress about wondering what the market's going to do. You're biting your nails every day as you see, some kind of interesting political development and it was unexpected. And then all of a sudden rates shoot up or drop. You just, it's kind of a stressful experience for the buyer by floating the rate when the market is as volatile as it's been over the last couple of years. At least that's my experience of seeing buyers float and what their mentality is during the process, and I find that if rates drop during the process, some lenders have renegotiation policies if the rate improves by over 0.25%, which, kind of can give you a little bit of assurance. But also, if rates drop, most people aren't as mad or upset about missing out on it versus when rates go up, when they have a floating rate. That hurts a little bit more. And especially if their ratios are tight, that definitely hurts, and that can hurt your pre-approval or your approval at that point in the process. Now, sometimes people still don't want to lock it in, and usually I'll be like, I would lock it in. Like, I don't think it's going to improve from here. And I remember I had a client and I just kind of kept urging her. I'm like, we need to lock it in. It's a Cal HFA loan. We got to put this lock in before 3 p.m. And finally she was like, okay, I'm still thinking about it though. And she's like, okay, though, like, let's do it. And I was like, let's do it. And then the next day rates were like 0.375% higher. And I'm like, thank God. I'm like, what do you do in that instance where they still want to float it? And you're like, but rates are going to go up, like, for sure.
It's terrible.
Yeah.
It's fine for some people. I remember 2020 and my clients just in the beginning of COVID when everything was so turbulent, by not locking their rate overnight, they lost like 10K. So I feel like floating is definitely something that some people like to do. Everybody to each their own, by all means. But there is a sense of stability in locking your rate for sure.
Peace and calmness. I feel like the beginning of the first week of getting your offer accepted is busy enough. throw in that stress of like not knowing what your payment is actually going to be and hoping the market improves and just like, you know, just very turbulent. Like you've got a home inspection to do. You've got to get your earnest money over to the escrow company. Like don't stress about your payment.
Yeah. I think, back in 2018, I had a listing, and that's another time when rates started to climb up, and I was in the middle of escrow and the buyer was floating it. I was like, hey, are you gonna lock it? Well, we're gonna float it. We're gonna float it. It kept going up each time, and I was just stressful because, my client, it was a condo, it was a move up type of process. So we had the next home up that they were buying a house on, relying on this person who's screwing around, floating with the rate. And so, it got very frustrating. And, my client was in a position, where someone's floating a rate. And then if it doesn't work out, then go back on the market and then lose the other. Like it's a challenge, so don't screw it up, get the house.
Right.
Okay. So what costs should buyers budget for, beyond the mortgage payment?
I'd say monthly maintenance costs, right? Utilities, that's not included in your mortgage payment. So budget for those. A lot of people don't know that when you own a home, you've got to pay for like the water too. That's usually included when you're renting. So there are added expenses. I'd say anytime you need renovations, you can't just call your landlord to come fix it. You have to pay for that. And there are things that come up. So I'd say you should budget probably at least 3 to 6 months. I like more. I like 6 months in reserves, just an emergency fund for the little things that come up. And then outside of the mortgage payment and outside of the down payment, a lot of people also forget about closing costs. So your cash to close on closing date is made up of your down payment plus closing costs. And closing costs are made up of lender fees, which are typically like anywhere between like $1,500 to like $2,300. And that's to pay, every lender calls it something different. It could be a processing fee, it could be application fees, origination fees, or underwriting fees, just something that goes to the lender for the loan, right? And then you've got the appraisal, which is typically going to be somewhere between $500 and maybe even up to $1,200, $1,300, depending on the type of property, whether it's a rush, whether there needs to be a rental income analysis. Then you've got title fees and escrow fees. That's a huge variable in California because, as you guys know, the seller is usually the one that picks the title and escrow companies. And so that's a huge variable. So I usually estimate that for my clients at the pre-approval stage, but I let them know that that's a variable. And then you've got prepaids, right? So your prepaid interest, which is just dependent on the day that you close. And, if you close on the 15th of the month, chances are you're going to be paying about 15 or 16 days in prepaid interest to carry you through the rest of the month that you have a mortgage. Then you have your prepaids like homeowners insurance. You typically prepay that for the first year so that you have a full year of homeowners insurance coverage. And then you have county recording fees. So all of these things come into play depending on whether your property taxes are due. That might be a closing cost for you as well, or you get a prorated amount from the seller, just depending on what time of year you're closing as well.
Awesome. Very, very good stuff to know. Very important.
Yeah. So Krystle's going to be on a call real quick, but I'm going to still be here. We'll see if she's going to come back. I'll just put her in backstage. So
I'll see you in a little bit. Thanks so much.
All right.
See you, Krystle.
Okay. Okay. What fees, from your experience, surprise buyers the most at closing?
It depends. I was going to say, sometimes when I get a loan from, like, they're changing lenders in the middle of the process and they're coming to me, the fees that they're most surprised by is the origination points, the discount points, which just PSA for everyone, public service announcement, discount points are not you getting a discount. You're buying down the interest rate and you're paying points, a discount point or origination point to buy down the interest rate. And that's a fee. That's a percentage of the loan amount. So I think that one surprises a lot of people. And I'm always surprised to hear that, some people are not like forthcoming as lenders, and trying to pull a fast one on people. I'm like, that's wild. And I'd say probably HOA fees at closing. So, if you're buying a condo or a townhome and you've got the different HOA fees, typically they didn't realize that they'd have to pay a certain month, and it's usually a prorated amount, based on when the seller owns the property and then based on when they'll own the property for the rest of the month. So I think that one kind of surprises people.
Okay. Let me see. We answered this question. So you answered this question too about self-employed buyers. Okay. Now a little bit longer term people who are, I guess, dreamers. What should someone do if they want to buy in the next 6 to 12 months?
Same thing.
Mm-hmm.
Pay your credit cards on time, pay down debt, maybe, strategically, depending. I still say have a loan consultation and see what it means for you. But don't buy a car, don't change jobs without talking to a lender, especially if it's that close. Really, anytime in the next 2 years, I feel like if your goal is to purchase a home, you should be working alongside a lender, especially if you've got big changes happening or you're trying to make big financial moves and you don't have the right guidance to do so. You don't know how it's going to impact you. Definitely just talk to a lender, save money, pay your credit cards, don't let anything slip into collections, and don't change jobs.
Okay. What documents should buyers start gathering now?
Depends on their income structure, but if we're talking about a just salaried W-2 employee who does not own any other homes, it's pretty simple. It's literally your 2 most recent bank statements, 2 most recent pay stubs, and 2 most recent W-2s. Typically, if you're just a W-2'd employee making a salary, probably don't even need your tax returns. So very, very simple for somebody like that. Now, if you're a little more complex and you've got self-employed income and a bunch of different K-1s and the works, we're probably going to be a little bit more intrusive and collecting a lot more. If you own several properties, we're going to be looking at the mortgage statements. We're going to be looking at the homeowner's insurance, the property taxes, the HOA bills, what the rental income looks like. So a lot goes into it. If you're, a business owner and we're doing a bank statement loan, we're going to collect your 12 most recent business bank statements. We're going to collect your probably a letter from the CPA just saying how long your business has been in business, and a business narrative of you explaining the business and the just all sorts of documentation. So really depends on the income structure.
Okay. So Sabina, what's one mortgage myth you wish more buyers understood?
Well, I immediately go to the 20% down payment thing. You don't need 20% down, but I want to come up with a better one because we did just talk about it. Mortgage myth. I hear them all the time. Oh, ARMs, adjustable rate mortgages. Everybody is so afraid of those. And, rightfully so. It was a huge contributing factor to all the bad loans written in, from like 2004 to 2008. And so a lot of the ARMs then were negative amortization ARMs. And so people could not afford their payments as the loan balances went up and adjusted and interest rates changed. So people could not afford the payments. And then, property values declined and people just could not get out of their homes. ARMs today are very different. A lot of people are actually choosing an adjustable rate mortgage lately. 5 or 6 or 5-year or 7-year ARMs are the most common. There are 10-year ARMs, there are 15-year ARMs, but that first number in the ARM, that's really important to know that it's fixed for 5 years on a 5-6 ARM, or 7 years on a 7-6 or 7-1 ARM. And it's really important to know what the client's goals are in those situations. If somebody's like, oh, I'm only going to live here for maybe 5 to 7 years. It's like, well, if an ARM gets you a better rate, why not consider that product versus a 30-year fixed? Most people don't hold their mortgage for 30 years. Contrary to popular belief, most people will either sell or refinance prior to that 30-year point. So ARMs are really good products for those people. And there are caps in place, right? For adjustment periods. So typically if it's fixed for, say 7 years, it's a 7-year ARM, it's fixed for 7 years. It's not going to adjust then. And at that point, if it's a 7-6 ARM, it's going to adjust every 6 months after that 7 years, depending on the overnight trading index, the SOFR index. And so at that point, it adjusts every 6 months, and it's dependent on what's going on in the market. That doesn't mean it's going to adjust upwards, right? If the market's better, it might adjust downwards, but there's going to be a cap as to how much it can adjust each adjustment period. And then there's also going to be a cap on how much it can adjust for the entire life of the loan. So it'll never exceed a certain loan or interest rate. So I'd say that's one of the biggest myths, is that ARMs are scary and you should never go into an adjustable rate mortgage.
And I think with a good consultation with you, I think that's going to be the best case scenario, no matter what you're looking for.
And it's okay. It's okay to be afraid of an ARM. I'm not trying to push ARMs on anybody. It's just understanding whether it makes sense for you and what you're comfortable with.
Yeah. One last question for you, Sabina, before we get into the comments from the people that are watching us, is what final advice would you give first-time home buyers watching this replay?
Get into the market as soon as it makes sense for you to get into the market, because home appreciation is impossible to outsave. And it's nice owning a home. There are so many different benefits. You're not going to be forced to move. You probably have a bigger space, more responsibility, right? But and chances are maybe even a little bit of a bigger payment, but then you realize that you might not have been spending necessarily in the right way prior to purchasing a home. So get in as soon as possible, just because that is your tool to building generational wealth.
Absolutely. All right, let's get into the comments. Hopefully nothing too scary. All right, first question, what is a USDA loan?
That's a great question, Conrad. I have never done one, but it is a government loan, 0 down, typically for low to moderate income borrowers. There are income limits, and I've never done one because a lot of people don't qualify for them. So it's not that I've tried, it's just that typically in an area like Southern California where incomes are a little bit higher, and it's not like the income limit changes for the program, and homes are more expensive. Their debt to income ratios are super low. So it's hard to get somebody to qualify there. But it's guaranteed by the U.S. Department of Agriculture. So they're basically have to be in an area where you can get a USDA loan.
Okay. Yeah, there are some places, I guess, south of here with ag land. So
Kern County has some live land that I know people can sometimes get USDA loans for.
That's good. Good to know. Okay. All right. Tiffany Gardner. Love you guys. All right. Tiffany, we love you too. Thank you for, having a testimonial. Okay. All right. Is it best to pay off a car loan before pre-approval?
Not before talking to a lender.
Gotcha.
Because if it's, if you've got a $40,000 car loan and that's all the money you have saved, and it might not even help you qualify for, more, or you don't want to qualify for more, then not necessarily. I would say talk to a lender and figure out the best strategy for you. So don't pay off your car if that's all the money you have for purchasing a home.
All right. Okay. Do I get pre-approved before or after filing my taxes?
Either or,
Okay.
right? So, if you're just a normal W-2 employee, it might not even have an impact on you anyway. So file away. But if you're self-employed, I usually tell my self-employed borrowers, let's get you pre-approved early in the process. Let's see what your tax returns look like now. Like sometimes at the end of the year, they'll be like, well, why don't I just come to you next year after I file my taxes? And I'm like, well, why don't we see what you can qualify for now? And if you need to, make any adjustments in your business before the year ends, you can do so. If you need to increase your marketing to get more revenue and show more income and, just make more money, then at least a lender can tell you, before the year ends and you have that time to increase revenue. Every business is different, but I'd say there's no reason you can't update your pre-approval during the process. You're not set in stone. If you, are looking for a year and you end up filing your taxes again, I usually have my clients, we update your pre-approval and we update your numbers just based on changes that have occurred in your financial persona.
Okay. Some of these I'm just going to fire away just to make sure that people will know that we're listening and watching their comments. So PMI, you answered. Crypto, yes, you answered. Good funds, you answered. Seasoned funds. What does, I think you mentioned it, but
money that's been in your accounts for at least 60 days. So seasoned funds are things that are appearing on the bank statements that are not a large deposit, right? So that's interesting because every large deposit needs to be verified.
okay. All right, it's that. Okay. Does marital status affect the loan? I think this is a strange question, but what
cannot
I guess
deny you based on your marital
oh
status.
yeah, well yeah, I think because we were talking about buying without the other spouse knowing.
And that's something in California. It's a community property state.
Mm-hmm.
So that will come up and people need to, your spouse needs to be willing to sign at closing. But also, if you're using a government loan, like an FHA or VA or USDA loan in California or any other community property state, even if there's just one person on the loan, we need a credit report for the spouse because it's a community property state and it's a government loan. They require that we add the debts and liabilities for the partner and make sure that we can cover both people in a marriage.
Okay. Right. Is there a cost for a rate lock?
It depends. Most of the time, no, in 99.9% of scenarios. But if you're, doing like one of those like long-term lock and shop programs, typically there is a cost involved. And it varies just depending on what the terms are.
I think it answers this question too, but yeah,
it's popular with builders. Builders will typically lock in a rate with the lender so that they can advertise the lower rates. So yeah, very common for builders to pay fees on locks.
Okay. That's all I have for, the lending. I forgot to put your information in the description. I promise everybody out there that it's going to be, if you need any real loan questions or advice or apply, reach out to Sabina. I promise to put that in the description on there. But Sabina, you have any final, final word. Sorry,
I
my
would
words.
say this was really fun, Conrad. I'm so glad that you had me on. I would love to come on again. I kind of was like, oh my gosh, I don't know what I'm going to talk about. And I was kind of nervous, but I'm like, oh my gosh, there is so much to talk about when it comes to loans in the loan world. And I think we have a lot more that we can cover.
Absolutely. So thank you so much for joining us. And I'm going to just, see you on the next one, and just kind of give everybody a quick deal of the week. So the deal of the week that I have, let me see here, in Los Angeles, Krystle had one as well. So maybe give you an idea. So in Los Angeles, there's a nice home that's a fixer. It's a 4-bed, 2 baths, 1,699 square feet. I'd reach out to Sabina on getting a renovation loan on it, because it's in a pretty good area of West-ish LA. I call it West-ish. But I think that would be a good opportunity for somebody. Yeah, about 1,600 square feet, 4,000 square foot lot, needs some work. So if you're looking for a fixer in LA, reach out to me. And that's all I have for as far as deals of the week. Everybody, thank you so much. Thank you so much, Sabina. And let's see here. Let me just add a little bit of music to the fun. So yeah. Thank you so much, everybody. And subscribe to our channel for more information on real estate. And share it with all your friends. And you guys have a wonderful day, and have a good weekend. Thank you.